Uh, Now, I'd like to invite Mr. Manoj Patil, a legal authority on the subject, and he has been representing, heading the legal part of WADI. And with that organization, it becomes that much more meaningful. So please, I'd like to have you.
Good afternoon, all. Thank you so much for the invite here. I'm heading legal functions at Vari Group. Basically, we take care of all renewable as a chain. So, the today's topic is a bit away from renewable. It's part of renewable also, infrastructure basically. So, I'll be just speaking on infrastructure and EPC financing, evolving models on today's date. It was predominantly bankers' job earlier days, but now there have been various over a period of time. I'll just tell you a story. A decade ago, there was a major highway project was funded with aggressive traffic assumptions. IR looked very attractive. Banks funded very confidently. Concession agreement was signed, and the project took off. 2 years later, the traffic assumptions fell by 20% short. Now the whole scenario changes. Refinancing became totally difficult, and then people thought like, how is project going to survive? Additionally, IRL was totally squeezed. Then, what was the problem? Problem was not that project didn't get funding, but the risk allocation which was not done properly. So, while any infrastructure funding is happening on today's date, the evolving methods which have come, sovereign funds, pension funds, and the InvITs and everything, they look at more risk proposition, how is risk diversified in the funding. So this has taken away the predominant role of banks in the infrastructure funding to the next level. So with that, I'll just take you through my presentation. It was thought to be a 40 minutes presentation, but I'll just try to squeeze that to the extent possible. So India's infrastructure requirement today is pegged around 1.4 to 1.7 trillion dollars. Basically, key sectors are roads, railways, urban infra, airports, power, data centers, etc. These areas are diversified on its own. They have separate risk appetites. They have separate risk exposures, methods, and how to cater those risks is something very necessary. Government has also come forward with many schemes and initiatives which are funding today's infrastructure projects, making the projects as more viable and also attractive from an investor point of view. So how the infrastructure financing has evolved over a period of time. As I said, like traditionally banks have led the project financing model with debt equity ratio of 70-30. It was highly leveraged. Then came the stress assets because NPHs started building, the risk allocation was not proper, and all the project financing had led to the bank NPAs. At some point in time, it was very difficult for a bank to consider financing for infrastructure projects. Those NPAs have actually led to a reformative stage in India's infrastructure sector, wherein various diversified capital stack and hybrid financing objects have started evolving. So, if you look at the bank lending model, earlier it was limited recourse project financing through an SPV. The SPV was basically funded by the banks for a particular project. This was secured by various mortgages over the lands, then hypothecation over the receivables and the movable assets of the project and the pledge of shares, certainly. It was more flexible for the banks to consider financing at that point in time. However, if you look at, there was a ALM mismatch between the banks itself, asset liability mismatch. If you look at the financing, infrastructure financing, typically it takes over 10 to 15 years of a lifespan. But on the other side, if you look at the deposits, tend to be shorter period in time. So this was a mismatch for the banks. It was difficult for them to manage the risk. And again, then it was a sector concentration. So if you look at taking exposure to an infrastructure sector itself, bank would never do that. And then this led to the various other models of financing. So now, if you look at the banks, keeping those risk things in mind, banks typically tend to project only the construction risk financing, basically. Then what happens after consideration is over? Then you need a refinancing after that. So then comes the role of capital markets. Capital markets tend to fund when the project has already commissioned and there is a visibility on the project revenues coming forward. So infrastructure bonds, green bonds, muscle bonds have evolved over a period of time than the traditional banking financing. Now, if you look at InvITs, there have been many InvITs which are going to be listed, there are listed, and so many things are evolving. But what to look at is something really important. Now, if you look at financing as not just security looked at the funding, but they also looked at governance aspects of the companies which are actually doing the infrastructure projects. So, there were lower cost of rated operational assets, then capital market tend to fund those projects which has high ratings on the credit side. And again, there is a risk of rating getting degraded, then your financing becomes unviable. Then comes the institutional financing. Like if you look at pension funds, insurance funds, sovereign funds, these are basically the funding methodologies which are evolved for a long-term financing. If you look at banks, takes care of the construction risk. Then comes the capital market rules wherein they look at the refinancing aspect of it, but what about the project lifetime? Then the insurance companies, sovereign funds, and the pension funds, which has a tendency to generate not more IRR, but a stable revenues evolving from the project. So the roles of these pension funds, insurance funds, and sovereign funds have become very critical. And if you look at they prefer to have operational assets, not the construction assets. They don't look at refinancing, they look at the long-term revenues coming from the project. Now comes the role of NBFCs. Assuming you are developing a project and at certain phase in time you need certain bridge financing, then the role of NBFCs comes into picture, because whatever you have undertaken for the project, there may be cost escalations, time escalations, which are led to increase in the cost of project. NBFCs tend to have a higher cost, but at the same time, they are very flexible for any project to actually go until the COD and then survive for the rest of the period. If the NBFCs doesn't play any role in that, then it will be difficult for the project to even commission and to go for long-term growth. Then comes the AIFs. AIFs has evolved over a period of time. Alternative investment funds, there are many SEBI-listed, SEBI-regulated alternative investment funds. What to look at is more from a governance aspect of any project, not just IRRs. Basically, they tend to look at stable revenues from the project, and then structured investment they look at over a period of time. And then, as I mentioned, pension and insurance capital is something long-term viability matching. They look at, they invest through InvITs and direct SPV stake also. Focus on toll roads, renewables transmission, where the project life spanning over a period of 20-25 years with the stable revenues linked with the tariff escalations and all. So these are the areas where pension and insurance capitals majorly look for investments. Is similar to pension investment funds, sovereign fund also tend to look at long-term investment returns, strategic diversification, and they tend to participate in airports, roads, and renewable platforms. Now, let us look at the various risk allocation models which government has come up, also the private entities have come up. Now, there are BOT, BOOT, DBFT. There are various models where the risk is allocated between government and the private sector. So, if you tend to look at the concession agreement for the private ports, they tend to diversify the revenue between government based on the model which they choose. After a certain period of time, you have operated the project, then transfer it to government, and then you can go away from the project. And the bankability of this funding is majorly dependent on the risk sharing. Who is sharing what risk? Construction risk, then project risk, then regulatory risk, and everything. If the risk allocation is proper, then these models are very investment. People will fund the investments in this kind of projects. Hybrid annuity model, wherein 40% government support comes during construction and 60% developer funding, mix of debt and equity, and fixed annuity payments post completion. As Mr. Dilip Panchwani just explained us how the annuity model works. So basically, after some period in time, this annuity payments are made to. Now comes EPC and PPC financing. EPC is fixed margin government funded project where the contractor takes away the EPC price. He is not going to run the project. Maybe operation and maintenance is given to him, but the revenue goes to government in such models. So on the similar lines, PPP project, private public partnership projects are basically tend to be driven on IRR based returns. So in PPP, in EPC, basically the risk for contractor is less unless and until he doesn't complete the project during the time. But in PPP side, risk and reward is equally shared between the contractor and the government. Now, if you look at emerging hybrid structures, asset monetization via InvITs, construction finance plus takeout refinancing, and mezzanine and structure equity models. If you look at asset monetizations, InvITs are basically investing in the fund, in the projects which are operationalized and they have fixed returns over a period of time. Then if you look at construction finance and takeout refinance is basically the bank's job which they are undertaking today, wherein for the construction phase they take risk and then they go over refinancing after the construction is over. And then if you look at mezzanine and structure equity models, this is basically distributed between various investment portfolios. NBFCs tend to invest in mezzanine or bridge financing functions, while the equity models tend to invest in the fixed return generating assets. Risk mitigation mechanisms, you have a escrow waterfall mechanisms in agreements wherein the risk is bifurcated over a period of project duration. DSRA basically gives leverage to the bankers to undertake funding based on certain parameters of the project. Then substitution tripartite agreements in the contracts, wherein if the default is there, the government can pitch in the projects, get another contractor in place, and substitute the original contractor for rest of the project life. There are partial credit guarantees also given by government, which helps this investment becoming viable. Current trend in infra financing. If you look at current trends, ESG-linked financing and green bonds have become quite popular these days, wherein there are several sovereign funds, pension funds are investing based on the ESG rating of a company. Then blended finance models are also in place where there's a mix of various finance models takes place, equity, then debt, and also pension funds investment and other models are there. If you look at increased financial institutional participation, these days infrastructure has been funded largely by government spends and also the foreign players based on the viability of the project and the credibility of the contractor in place actually. Now if you look at the key challenges, land acquisitions and regulatory delays has played a major role in delaying the project. And if you look at the land acquisition today, it's very difficult. Both private land acquisition is also very difficult to do as well as the government land acquisitions because there are plenty of delays on the side. And this affects the project IRRs. Then state counterparty risk, if you look at the urban infra, then municipality credibility is very important, where the municipality credibility plays a role whether the project is viable or it's going to be difficult to achieve IRRs. And again, refinancing traffic risks, basically the roads projects, airport projects, traffic is very important, assuming if there are aggressive traffic allow assumptions, or if you look at their mismanagement of the traffic risk, then it's very difficult for any project to survive. Way forward, so basically we have to deepen our bond markets. We have to come up with various products on the bond markets which can make the funding viable, at the same time also achieve IRRs which are expected to achieve at the time of the project. Expansion of InvIT platforms. If you look at the InvITs have taken very strong, you can say like aggressive position in the today's market financing for infrastructure projects. I think we have to develop more and more InvITs, or the government has to come up with certain policies or schemes which will help these InvITs to expand their growth in India. And again, stronger governance project preparation is something very important from a contractor perspective, wherein contractor has to balance the risk as well as rewards in the project to make the project viable. I am just curtailing my speech because there is nothing much ahead. This was something I thought to present to you. Thank you so much. Yeah. Yes, please.
So, if you can elaborate on partial credit enhancement. Recently, NAPFID also has come up this. They are going to support in terms of partial credit enhancement. How it works?
I'm sorry. Sorry.
Partial credit enhancement.
Partial credit enhancement.
Okay. I think my friend Dilip Panjwani can answer this.
Credit enhancement works in two ways. One is if you got a parent company, which is supporting an SPV, then probably a letter of support, letter of undertaking, or by guarantee. Those are the three methods in which credit enhancement works. Or if you have the second method is if you have a relationship with a financial institution, they can provide a sort of comfort letters, towards the knowledge, but that is yet to evolve in India. The largest form of credit enhancement in India is still a parent or an affiliate support in three forms, comfort letter or undertaking, shortfall undertaking essentially, or the third method is guarantee method, These are the methods in which credit enhancement takes place. But now government is also talking of credit enhancement by financial institutions, but we have to still see how it evolves,
Thank you. Thank you all.
Thank you very much for taking us through, Mr. Manoj, and it was really wonderful.